I'm Shanali Ashika Ratnaka from Group 028. So, my part of the presentation is the background of Commonwealth Bank of Australia. I will start off with the introduction. The Commonwealth Bank of Australia is an Australian multinational bank with business across New Zealand, Asia, United States, and United Kingdom. It provides a variety of financial services, including retail businesses, institutional banking, fund management, superannuation, insurance, and so on. So, by August 2015, the Commonwealth Bank became the largest Australian listed company on the Australian Securities Exchange by including Bankwest, Colonial First State Investments, ASB Bank, Commonwealth Securities, and Commonwealth Insurance. So, let's dive into the history of the Commonwealth Bank. So, Commonwealth Bank was founded by Andrew Fisher and King O'Malley on 1911 under Commonwealth Bank Act. So the first branch was opened in Melbourne on July 1912. So in 1920 they began to acquiring central bank powers, but on the 1960 they fully acquired all the powers of a central bank. So later on, they diverged into many areas like businesses, travel, and insurance. And also, they created the first credit card of the country on 1974. 1983 to 1991 was the deregulation period. By 1996, the Commonwealth Bank was fully privatized and merged with Colonial Limited on June 2000. So after year 2000 to now, the Commonwealth Bank have many branches all around the world, and we can say it's the largest bank in Australia. So let's see the structure of the bank. There are four main divisions of the structure. So first one is retail business services, the second one is premium business services, and the third one is wealth management, and the last one is executive leadership. The retail banking is simply providing financial services to personal and small businesses around the country. But in the premium business services, they have two parts like institutional banking and markets, and business and private banking. So in the institutional banking, they provide financial services to institutional clients, and in the business and private banking division, they provide financial services to business clients and their private banking. So in the wealth management, they provide so many support to so many areas like group fund management and master funds, superannuations, and financial advisors to business, and so on. So, and last I'm going to talk about the executive leadership of the company, and there are a list of people who appointed as the chief executive of the company, as the CEO of the company throughout all the years since 1912. So but in the present, the CEO of the company is Matt Comyn. So I'm going to end my presentation right here. So I'm going to hand over the rest of the presentation to my partner. So thank you.
Hello everyone, this is Amisha Bista and my student number is EMV 80593. Today in this accounting group presentation, I have worked on calculating the ratio of Commonwealth Bank, for which I have chosen liquidity ratio and solvency ratio. So let's begin with defining what liquidity ratio is. Liquidity ratio are those ratios that measures the ability of the company to meet its short-term obligation and the ability of the company to pay its short-term liabilities when they fall due. Generally, there are four types of liquidity ratio. They are current ratios, quick ratio, cash ratio, and net working capital ratio. Current ratio can be calculated by dividing current assets by current liabilities. Quick ratio can be calculated by cash plus marketable securities plus account receivable divided by current liabilities. And cash ratios can be calculated by cash and cash equivalent divided by current liabilities. And finally, the net working capital is calculated by current assets minus current liabilities divided by total assets. So let's jump on defining what solvency ratio is. It is a liquidity ratio to measure the business ability to meet its debt obligation, and it's generally used by business lenders. This Ratio indicates if the company's cash flow is sufficient to meet its short and long-term liabilities. There are three types of solvency ratio. There are debt to equity ratio, debt to assets ratio, and interest coverage ratio. Debt to equity ratio can be calculated by total liability divided by shareholders' equity. And similarly, debt to assets ratio can be calculated by total liabilities divided by total assets. And the third, interest coverage ratio can be divided by earning before tax and interest divided by company's interest and expenses. After looking the annual report of Commonwealth Bank of two financial year 2020 and 2019, we have calculated different liquidity and solvency ratio. And after calculating, we got the current ratio of 2020 1.04, quick ratio 0.059, cash ratio 0.046, net working capital ratio 0.043. And for the financial year 2019, we have got the current ratio 1.03, quick ratio 0.046, cash ratio 0.032, and net working capital ratio 0.031. Similarly, calculating the solvency ratio of financial year 2020 and 2019, we have got the debt to equity ratio in year 2020 is 13.08, debt to assets ratio is 1.07, and interest coverage ratio is 7.92. Similarly, in 2019, debt to equity ratio was 13.02, debt to assets ratio is 1.07, and interest coverage ratio is 7.17. This comes to the end of my presentation. Now I'd like to hand over the rest of the part to my group member, Upender. Thank you.
My name is Upender Singh Swan and my student ID is AC30203. I'm going to continue the interpretation of the financial ratios after we have done the calculation of the financial ratios. So moving forward, I will talk about why it is important, why did we choose it, and how can we maintain it. So starting with why did we choose this ratio, we chose the liquidity ratio and the solvency ratio. So with the liquidity ratio, we chose it to determine whether the bank has enough liquid assets to meet its financial obligation, and we chose the solvency ratio to determine if the bank is using more leverage. A higher solvency ratio might reduce the credit worthiness of the bank and also determine if the bank will be able to pay its debt obligations. So further we talk about why is it important to our chosen company. So like why is it important for our bank. The bank we chose is Commonwealth Bank. So it's important for the liquidity ratio is important as it helps an organization to pay its day-to-day expenses. So it's very important for organization to have a higher liquidity ratio. And for the solvency ratio, it helps an organization to meet its long-term financial obligations. Lower solvency ratio might increase the bank's credit worthiness. So in short, we can say that a bank should have a higher liquidity ratio and a lower solvency ratio for its survival. Further, we talk about what does the ratio indicate. So the liquidity ratio examines whether a business has enough money to pay the money it owes. Moreover, the solvency ratio determines the capacity of an enterprise to meet its long-term financial obligations. Coming towards the last point, we talk about what actions can company do to influence the ratio. So the company should maintain the current ratio, improve the quick ratio, and improve cash ratio, and improve the net working capital to maintain the ratio of the organization. For our bank, what we need to do is first of all we need to maintain the current ratio. So how to maintain the current ratio? To maintain the current ratio, we need to delay any capital purchases that would require any cash payments. Secondly, we have to sell any capital assets that are not generating a return to the business. Secondly, we'll go to improving quick ratio. In quick ratio, we can improve the quick ratio by increasing sales and inventory turnover, improving invoice collection period, discarding unproductive assets. Um, Further, we talk about improving cash ratio. To improve the cash ratio, first of all, we need a faster conversion cycle of debtors or account receivables. Secondly, pay off all the current liabilities of the organization, like for the bank. And lastly, we talk about improving the net working capital. So first of all, I will tell what is net working capital. It's the difference between the company's current assets and liabilities. So to improve the net working capital of an organization, the organization must have sufficient funds to meet its financial obligation and invest in other activities, which shows the company has the positive net working capital.